It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc, and we haven't discussed this recently, so we should bring this up about the Federal Reserve. There has not been a lot of news on the Federal Reserve since they decided in June to pause on interest rate hikes. Very recently, there was a conference where the Federal Reserve Chairman, Jerome Powell, one of the questions, it was very interesting, he was asking him, and it was a conference with him and several of the other world banks, the leaders of the world banks. And the question that was asked very directly of these World Bank leaders was, are there any interest rate deductions or reductions on the horizon? And all of them agreed and stated that not only was there no interest rate reductions intended or expected in 2023, but also not in 2024. Now, that comes as news for a lot of people because, for so long, first we were hearing how inflation was transitory, and of course that went away. Most of us understood that was a bunch of hooey. But anyway, that whole idea went away eventually. And then they were going to raise rates, and most people thought after they raised them that they were going to drop them quickly, especially once the peaks of inflation started to come off. But the reality is, as I've been stating on this show from the very beginning, inflation is one of those things that's very sticky. It's very difficult. Once that genie is out of the bottle, it's really, really hard to put it back in. And it just tends to stick, kind of like peanut butter on the roof of your mouth, if you know what I'm saying. And the central banks, the world central banks, have finally come to that realization, and admitting, I think they knew all along, but actually admitting it, So the fact is, we're in a situation economically where we should expect interest rates to be, actually, they're really at more normal levels now, historically speaking. For so many people, they feel high, they feel high because the reality is we've had low interest rates, historically low interest rates, for approximately 12 years. We had the lowest interest rate environment in the history of our country, literally, since 1787. That for the longest period of time, the lowest and longest low interest rate environment we have ever seen as a country. Of course, the central banks, extended it far beyond what it should have been, far longer than it should have been. Most people understood that. Most people agree, and even the central bank agrees today, far too late, of course, that they kept rates too low for too long. So now they have to keep rates most likely where they're at, possibly even a little bit higher. But even though interest rates do feel high, they're actually around historical norms. The fact that they are saying that they have no intention, no plans of lowering rates anytime in the rest of this year through next year, 2024, really comes as no surprise when you look at this as at a historical long-term perspective. Now, what does that mean for our money, investments, assets, all that kind of stuff? Well, of course, in a higher interest rate environment, real estate particularly tends to suffer more. Stock market to some degree also. Again, one of the things I always share is the things that worked really, really well in the past decade in a low interest rate environment, an easy monetary policy, tend to not do so well in a environment where the interest rates are more at a normal or high level, right? And the things that struggled for the past decade, like fixed interest, fixed investments, dividends, CDs, bank monies, things like that, those bonds, whatnot, those things that tended to struggle the last decade or so because of the low interest rate environment will now actually thrive in this new normal to maybe a little bit higher than normal interest rate environment as the central banks continue to try to fight inflation. Now, what that means for your personal bank is great news, because I'll give you an example. I was talking to one of the CFOs. Well, the thing is, what the great news is, and then I'll get into the detail, is again, in a more normal or little higher than normal interest rate environment, dividends increase. So the rate of returns increase. And the thing we need to understand is exciting about this whole situation for the personal bank in terms of dividends and returns and all that is, well, we've actually just gone through, like I said earlier, the lowest interest rate environment in the country's history for the longest period of time. From a return standpoint, you could say the dividends or the interest rate environment was these insurance companies, it was like their Great Depression in terms of returns, the lowest returns they've ever seen. And so the fact that they were able to still pay upwards of 5.75 to 6% dividend through that entire period without missing a beat, without missing a single year of paying dividends. And like I said, I have several companies that have never missed a dividend since literally before the Civil War, still have strong cash reserves, A+ rated, all that stuff to come through that period of low returns, the lowest they've ever seen in the history of their companies. That's impressive. These companies are excited about the higher interest rates because dividends are going to go up. Their returns, their profits are going to go up. What a lot of people don't realize is that insurance companies, primarily, what do they invest the money in? And it's bonds, primarily corporate bonds. Upwards of 70 to 80% of a portfolio of a typical insurance company, a good quality one, that is, will be in bonds. And I was talking to the CFO, for example, of one of the companies not too long ago, and he mentioned that prior to the Federal Reserve about a year or so ago starting to raise rates, that they were getting a 2% profit on their bonds. And then as soon as the Fed announced that they were going to raise rates, they had not raised them yet, but as soon as they announced they were going to, they started getting 4% profit on their bonds. In other words, double. Their profit doubled on 75, 80% of their portfolio. Folks, that's huge. Again, when you're talking about billions and billions of dollars invested, right? And obviously, since that time, the Federal Reserve has raised interest rates at a faster percentage clip at any time in their history, over 100-year history. So the profits that these insurance companies are now making with the higher interest rates on the, means increasing dividends. The predictions that we're hearing from just nearly everyone is that we are going to be in an increasing interest rate environment for at least easily the next 3 to 5 years, if not the next decade. And if and that holds true, because if the Federal Reserve sticks to what they say they're going to do, obviously things can change. We all know that. But they've been, to be fair, once the Federal Reserve got off the whole idea of that inflation was transitory, that was just a joke. I think almost any rational person understood that was just political theater, and it was not accurate. It was not real. It was a joke, and it didn't last long. And people they had to move on from that because it just became abundantly obvious that inflation was not transitory. But the fact is, since that point, the Federal Reserve has done a very good job of projecting what they're going to do, and for the most part have actually followed through on that. By them stating there's no intention, no plans of reducing interest rates through 2024, that means we're going to be in a solid interest rate, relatively on the historical average, or maybe on the little bit on the high side. These bonds that these insurance companies are purchasing are getting them a higher return. They're making more profit. And dividends are profits of the company, folks. So they pay a higher dividend. And to give you an idea, a little bit of perspective, historical averages, when you go back and look, the historical average of dividends on these personal bank policies average around 7-8%. That's the historical norm. If you go back to the late 90s, early 2000s, that was what they were paying because, again, that was really the last normal interest rate environment that we have experienced. So they will be, right now at 5.75 to 6%. That's the low end. We expect it to go up. We expect it to go up for the next number of years. And folks, that is great news for anyone who's looking at investing money safely with some guarantees, income tax-free, having high liquidity, and it's also great news for our future positive arbitrage. Because as dividends continue to increase and we earn more on the money, and then as the interest rates then at some point slide back down maybe a little bit, we'll start getting a little bit lower borrowing costs. And that's where we get the positive arbitrage or positive cash flow. In other words, you're earning more in dividends than you're getting charged in interest when you access the money, so therefore you keep the difference. And historically speaking, most of the time, that's exactly what happens. As dividends increase, we could see a scenario, I foresee a scenario quite likely where we have higher increasing dividends, and then the interest rates slide back a bit, the borrowing costs go back down further, and we get increasingly widening gap in terms of what we're earning versus what we're getting charged when we access the money, and getting a higher positive arbitrage than maybe we've seen in quite some time. So it's pretty exciting time for the personal bank returns, the dividends. Again, it's going to thrive in a normal or higher than normal interest rate environment, or maybe some other assets like real estate and the stock market have struggled. They thrived last decade. This next decade may be the decade of guaranteed investments and dividends and such like that. I'm going to go into this a little further in depth, and so I'm going to really encourage you not to miss this. So stay tuned in the next segment, because we're going to go into this and share how you can really benefit from this and increase the amount of money you have available each and every year going forward, how you can build wealth, continue to do what you're doing, but add additional return on your money on top of it. In other words, get your money to work for you more than one time. This is even more important in a period of time where interest rates and particularly inflation are at higher than normal levels. Look, interest rates are about normal levels historically, but inflation is not. Inflation is still much higher, about double roughly of what normal levels are historically. So you've got to make your money work for you. You've got to make it work for you more than once. You got to make it go further, because of inflation is definitely eating away at the value of your dollar. So your dollar better do more for you if you just want to keep up even, much less get ahead. So I'm going to encourage you to stay tuned in the next segment. I'm going to go into that further. Don't miss it.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. So, as I've been discussing in the first segment, the rising interest rate environment is definitely going to be a boon, a benefit in terms of dividends, increasing dividend rate environment. You know what they always say, buy low, sell high, right? Well, the dividend industry, the interest rates, the lowest interest rates in history, we're talking the history of the country. So we're not even talking about a generational low. We're talking about a historical country, a history of the country low in terms of interest rates and dividends. And that, of course, has gone up. The interest rates have gone up dramatically. Therefore, the dividends will be going up accordingly. Now, they'll move slower than the banks. The banks change their rates monthly, okay? And the insurance companies change their dividends annually. So they're catching up. It's going to take them time to catch up. They will. But that's interesting because they're slow to move on the way up. They're also slow to move on the way down. So even if the banks go up and then slide back down some, the insurance companies will still be on the rise for a while because they just average things out over like 30-year periods, folks, 20 and 30-year periods. So that's how they kind of level things out and make it more smooth. But again, it's going to be an incline, rising incline. That's why we say even if the Federal Reserve stops raising rates, even if they stop now, which is uncertain if there's talk still of them raising some more. We'll see. But even if they stop now, the dividends are going to go up for the next number of years because they're just going to gradually go up as they get back to norm, if you know what I'm saying. I was just talking to a prospective client just a few minutes ago before I started recording the show, as I've been saying to him and many, many other folks. The reality is this. The number one question I'm receiving right now, I'll just tell you right now, the number one question I'm getting is, where should I put my money? And that's a very valid question because so many people are used to that low interest rate environment for the past dozen years, okay? That easy monetary policy, if you will, which meant if you bought stocks or real estate, for the most part, they probably went up. And that's how it worked, because those types of assets really shine, they increase in value when interest rates are low. On top of that, over the last few years, the Federal Reserve was even purchasing assets, purchasing stocks, bonds, mortgage-backed securities, which further increase those asset values, right? The things that do well, thrive, if you will, in a low interest rate environment, stocks, real estate, for example, will then tend to not do so well in a higher interest rate environment. Vice versa, the things that struggled in that low interest rate environment, guaranteed assets, bank money, bonds, dividends, those types of things that struggled in a low interest rate environment will now thrive. In other words, the Federal Reserve has completely flip-flopped our economy. And they always say, don't fight the Fed. They're right. They're the 800-pound gorilla in the room. They have completely flipped the economy. So the stuff that worked before, I'm not saying it won't work at all in the future, but it's certainly not going to work nearly as well as it did before. And the things that did not work so well, of course, will now thrive more. So where should you put your money? Where do I see the smart money going? Where's a lot of the smart money? It's in the guaranteed investment stuff. It's in the bank money. It's in the dividends. It's in the bonds, the personal bank policies, all of those things, because those are things that are paying 4 and 5 and 6% interest right now. Likely you'll pay more. And that if you take, say, a 6% return like the personal bank policy dividends will pay, for example, and you add on top of that, get income tax free if we set it up properly, which of course we do, right? You look at 6% with guarantees and tax free, that starts competing very favorably against, say, a portfolio in the stock market or real estate portfolio. And we all know, of course, those have risk, okay? They just do. Well, if you can have some guarantees and to be tax-free, and it's consistent and steady and on the rise, and likely to be on the rise for the next several years, well, that's one of the reasons I like the personal bank policy so much, because again, 50 to 90% of your money will be liquid day one, depending on how we structure it. And I can show you how that works. But the bottom line is you have a tremendous amount of liquidity day one, in addition to the guarantees and the solid returns and the increasing dividend environment we're in. You know, with that liquidity, it takes away the one real big negative you typically see with guaranteed or insured or whatnot type of investments. That is just taken off the table. And the beauty of that is this: if you have access to to your monies, the majority of your monies, day one, and then you see, I've shared on this show a number of times, I still believe we're going to be going into a recession. All the leading economic indicators are pointing to that. If we do indeed go into a recession, then there will be opportunities to buy assets, things like stocks or real estate or whatever, low points, buy low, sell high, right? You'll have the opportunity to buy something at a price that is very favorable, that maybe you haven't had the opportunity to purchase at that price for a number of years even. And if the money is cooking along, just making its return, and it has guarantees and tax-free and all that good stuff, but then on top of all that, it's liquid, highly liquid, and when you access it, you can get positive arbitrage. My gosh, folks, you can take advantage of those opportunities when they do present themselves, okay? You can pull the trigger and say, you know what? That makes a lot of sense. And, we've done this personally in our own lives. Whether it's, investing in another asset or purchasing an item. There's things out there already because of the economy slowing down. Because the interest rates increasing. It's no secret. Real estate values in a lot of places have started to come down. My opinion is, I don't think it's done yet. Most people's opinion is that. Most experts, we'll see. But there's other things you can purchase these days that the selling price, if you will, was much higher even just a few months ago or a year ago than it is today. And maybe there's an item or something you wanted to purchase that you say, hey, I've been wanting that or needing that, and I didn't want to pay that much for it, 6 months ago, but now you could. And if you have money to access in these policies, you can access it at little or no cost. Folks, that's the other thing. Instead of, say, purchasing a vehicle or an RV or whatever that may be, instead of financing that item, maybe you can access it from your policy, as we have done, and you have little or no borrowing costs. So guess what happens? You know, if you look at a new car loan today, credit, you're probably 7-8%, okay? And other purchases like an RV or something could be even more than that, interest rate wise. What if you just eliminated that interest rate cost? The cost of that purchase just got a lot less because you're not paying any interest on it. And on top of all that, it's even better than paying cash, because if you pay cash, of course, you actually give up the ability of that cash to earn interest for you in the future ever again for the rest of your life. You give up that cash to purchase that car, for example. You get the car, yes, but you don't get the return on the money in the future. That money's gone. You traded the dollars for the car, right? Well, if you instead put in the policy, then access the funds through the policy, as we have done ourselves personally recently, you can then actually earn interest on that money, because the money in the policy is still earning dividends. The gross cash value is still getting dividends. And then you have an interest, they charge an interest rate against it. And the dividend is typically higher than the interest rate they charge. You get to keep the difference. So guess what, folks? When you buy that car, you buy that RV, you buy that item, whatever that may be, as we have done again personally, you still earn some interest on that money. And as dividends likely are be going higher, as I stated in the previous segment, because of the higher interest rate environment, we expect increasing dividends for the next number of years. Guess what? That money that was spent to buy that car is actually going to earn more and more dividends for you. And as long as, again, the borrowing cost is less than the dividends you're earning, you keep the difference. And again, that's been true for 42 of the last 43 years. We're in a situation this year where it's odd, but we're almost at a break even this year. The beauty is the cost of borrowing. Would you rather pay something like 0.4% to borrow money today, even though we have an odd situation with this year, or 7, 8, 9% on a new car purchase, for example? The difference is obvious, okay? And in normal scenarios, normal years, the difference is a positive. In other words, you're earning more in dividends and you're getting charged an interest. So that new car purchase, the money you use to purchase that car, if you were going to pay cash, you're still making a little bit of interest on it. And look, if you just make 1%, let's say you make a 1% positive arbitrage, you're getting paid 1% more than you're getting charged. That's 1% you're earning on money you wouldn't have had any other way. In other words, you use that money to purchase a vehicle, for example. You were using our example, or any other item for that matter. If you're going to purchase items anyway, and folks do, let's face it, we buy things, okay? Human beings, we buy stuff, and we either pay cash for those things or we finance it, right? We're either going to earn interest on that money when we purchase those items, or somebody else is. And that is the law. That is a law of what's called the lost opportunity cost. Maybe in the next segment, I'll get into this a little further. The point is, wealthy folks understand lost opportunity cost. Most people with, unfortunately, financial literacy is lacking in this country. Most people don't. I'm going to touch on that some more because I think this is a very, very valuable topic that needs to be discussed further. So I'm really going to encourage you, don't miss it.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to Your Personal Bank Show. This is Ference. So at the end of the last segment, I really got onto something that I find most people don't really have a firm grasp on. And it's a financial literacy concept called lost opportunity cost. And unfortunately, most of us are not taught financial literacy in school or by our families or parents or anyone else for that matter. And unfortunately, we're kind of left on our own. I mean, let's face it, who was actually taught how to balance a checkbook? Let me give you a quick little secret. So I learned this one, believe it or not, from Oprah Winfrey of all places. but it was a fantastic financial literacy key. If you hate balancing checkbooks, and most people pay bills online now and all this. I do too, but I've never liked balancing a checkbook, right? Well, here's the thing, particularly if you run a business where you run a lot of volume of funds in and out, it's really a tedious task to do that. So this is something I've done for, 15 years at least, something like that. You have actually two accounts, and I've taught this to many of my clients, and particularly my business clients. You have two accounts. You have an income account and an expense account. All your income goes into that income account. So if you have vendors that pay you or customers that pay you or whatever, they pay you into, or you can apply this personally, your paycheck, whatever it may be. Anybody that pays you goes into that income account. Now, this is valuable. The other thing about the income account is you never establish a check. You never write a check or even have a checkbook to it. You don't have a debit card to it, nothing, ever. Why? This is super important. The only people that know about that account are the ones that are putting money in it. It will just about completely eliminate any fraud out there because nobody knows about the account. You're not using a debit card off it. You're not writing any checks. I've had zero issues for over a decade with our business income account because no one knows about it except for the people putting money in it. Now, the second account you have is a debit account or an expense account. That's where you pay all your bills. That's where you have your bill pay, your debit cards, checks, whatever it is you use to pay bills. Pay expenses, okay? You only keep a balance in there to cover whatever expenses you have. Personally, I generally pay bills on a monthly basis. Everyone's different, but you figure out how much you have in expenses for the month. You do an online transfer from your income account to your expense account, pay all the bills, have a few bucks left over just to make sure nothing goes wrong. All the bills are paid, and guess what? Whatever's left over in your income account is your profit. You never, ever have to balance a checkbook, and it also does a lot to eliminate fraud. So there's a little tip that some of you might enjoy. Appreciate it. Now, let me get back to the lost opportunity cost, because that one was a simple one. Lost opportunity cost is a little bit more complex, but also is very, very important, very valuable. And what lost opportunity cost comes down to is this. And before I get to that even, I just want to share this, why it's so important is because it's about understanding how to manage money wisely. How do you manage money and make sure you're being the wisest, the smartest you can about managing strategically the money that you do have? Lost opportunity cost is a huge key that I see is probably the number one misused financial literacy tool that's just not used by the middle class average Americans. And okay, so this is what it is. You have some money and you want to purchase an item. And I'm going to use a car as an example, but whatever you purchase, it doesn't matter. Whatever you purchase, it can be small, large, anything in between. This principle applies. And what it is you have a choice, and particularly with larger ticket items like vehicles, if you want to purchase a car, you have a choice. You can either pay cash for it or you can finance it. What you'll have a lot of people say is, well, the best way to do it is pay cash because you don't have to pay any interest or finance charges or any of those kinds of things. And they are correct in that statement that you do not have to pay the extra interest, finance charges, fees, whatever that may be. That's true. But what the person that's paying cash is missing when you trade that dollar for that item. So if you spend money on a car, for example, you pay cash, that cash is now forever gone from your control. You took it out of your pocket. You gave it to the car dealer or whoever you bought the car from, for example, and you traded those dollars for the vehicle, right? Now, yes, you have a vehicle. That's all well and good. But what about those dollars? Well, somebody else has those. Here's the key question you need to understand lost opportunity cost. Will you ever benefit from those dollars at any point for the rest of your life? And the answer is obvious. When you trade those dollars for that vehicle or any other item you purchase, those dollars are gone, and they are gone forever. Folks, that's a key point you need to understand. Forever. Why is that so important? Well, what if those dollars could have just earned you 1% interest? Just 1%. The reality is they would generate a lot more dollars. That interest would generate a lot more interest back to you than you would have had in the first place. But then the question always comes up, but I want to buy or I need to buy this car. Okay, I get that. That's where the personal bank comes into play. The personal bank policy allows you to put the money in the policy to earn dividends, earn interest. You're gaining on the money. And then you decide you want to buy that same car. Instead of paying cash for it and giving up control of that money, you still actually maintain control of those dollars. What does that mean? It means you continue to earn dividends on it. Why? Because what are you doing? When you purchase that car, you're actually borrowing the money, you're accessing the money, typically, in most cases, from a bank line of credit. That's how we typically do it. Now, if you are accessing the money from the bank line of credit, are you getting the money from the insurance company or the bank? And the answer, of course, is the bank. What's the money doing at the insurance company that you gave them? Earning dividends. Every year, with guarantees, compound every single year for the rest of your life. Folks, if you understand compound interest, this is a powerful tool. It's been attributed, Einstein called compound interest the eighth wonder of the world. I don't know if Einstein said it or not, but it's definitely a powerful, powerful concept. Compound interest means your money grows every year at an increasing rate. You have more and more and more money every single year. On the borrowing side, this is where people get hung up. This is where they get messed up because we get told never borrow, never have debt. Again, that's another financial concept I've talked about in other shows, or you can go to yourpersonalbank.com. You can listen to it anytime this or any of the other shows, and you'll find where I talk about strategic debt versus consumer debt. We all know that not all debt is bad. If you ask any real estate investor, anyone who owns real estate, and they took a mortgage to purchase the rental property and then rent it out, and their rental income is greater than their expenses, that's called positive arbitrage or positive cash flow, right? Can you grow wealth that way? And the answer is, of course. We all know that you can grow wealth that way. And guess what? You took on debt to grow that wealth, didn't you? That is called strategic debt. In other words, you're earning more than you're getting charged, and you're keeping the difference. That's your profit. That's your positive cash flow. That's your positive arbitrage. Well, what if you could do that with money? Think about that a minute. I'll say it again. What if you could create positive cash flow with your money? We understand how you can do it with real estate, with rental property. What if you could do it with money? Folks, you can. Again, you put it in the policy. They pay the dividends. Who's paying the dividends? Are the gains based on you or somebody else? Based on someone else. It's based on the insurance company paying dividends and the money growing, right? Now, when you borrow from the bank line of credit. Where are you taking the money from? The insurance company or the bank? Again, the answer is the bank. The bank's going to charge you interest. As long as the interest is less than the dividends you're earning, you keep the difference. That's called positive arbitrage or positive cash flow. You are doing the same thing with money that real estate investors are doing with rental properties. When they take loans, mortgages against property to then rent the property out for rental income, and they're keeping the difference. Folks, what's the difference? Now, there's an advantage, by the way, to getting positive income off of money. One, the dividends you're earning, there's guarantees. It's also tax-free. There's no rental people to deal with, okay? There's no toilets to fix. That's a joke I always hear. I'm not being negative to rental real estate, but please understand the difference. There's no toilets to fix. It's your money. And then when you access the money and to spend it, purchase an item, whatever it may be, you're keeping the difference. You're still earning interest, dividends on that money for the rest of your life. And you can do that even this year. And every year the rest of your life. Think about that a minute. How much more money would you have if you were able to gain just, say, 1% interest on all the money you spend? I know that doesn't sound like much, but you add it up. You put a pencil to that, and you start to realize, you start calculating out what that is, and that, folks, turns into a tremendous amount of money over your lifetime. Look, you're going to take money, and you're going to purchase items. You're going to buy cars, vehicles, whatever, over your lifetime. Those things are going to happen. We're human beings. We buy stuff. We buy food. We buy clothes. We buy shelter. Okay, we do those things. What if you could get some positive cash flow from your purchases? You would have more money. You'd have more money each and every year going forward. You were going to buy those things anyway. I didn't tell you to do that. You're going to do it anyway. You either benefit from it or the lender benefits from it, because the last way to purchase when you finance, of course, we all know you not only pay the purchase price, but you pay interest to the lender, which means it costs even more. And guess who benefits from that? Who benefits from that cash flow? The lender. It's up to you. You can keep funding these lenders. Trust me, they're doing fine. They're making money. Or you can decide to stop and keep that money and have that cash flow come to you. It's up to you. It's your choice. If you want to learn more, contact me at yourpersonalbank.com. Stay tuned in the last segment. I got some fun stuff I want to share with you, and some interesting stuff, and some I think will even make you laugh, so don't miss it.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to Your Personal Bank Show. This is Ference. So I've been covering a lot of stuff about interest rates and the Federal Reserve and lost opportunity cost, how you can earn positive cash flow on your money, just like real estate investors do with rental property. Look, if you missed it, go to yourpersonalbank.com. You can listen to this or any of the previously recorded shows. I say so myself. It was really good. So you'll learn a lot, and it'll be very beneficial. So really encourage you to do that. The last thing I want to share this last little bit of time we've got left is seeing some things on the fiscal political front that are encouraging. And if you've been listening to the show for a while, I've been pretty frustrated about a lot of things, particularly on the political side of things and fiscally speaking, because there's just so little fiscal responsibility out there. It's just frustrating on the political arena and with our government. But there's some positive things, and we need to share that to not get totally discouraged, because it's not all is lost. And here's one of them. So Republican lawmakers in Wisconsin voted to cut $32 million from the University of Wisconsin's budget due to the promotion of diversity, equity, and inclusion programs, these DEI programs. And the state lawmakers, and this is great, say the $32 million cut is the amount the Wisconsin University is spending on DEI and initiatives. They just want it cut altogether. And so this is brilliant. In other words, you want to get at something. You want to get to somebody, you'll you take their money. And this is another way. It's the old carrot and the stick. I love this. They said lawmakers could get the $32 million back if they show the money could be spent elsewhere. So in other words, the university can get this $32 million. And folks, that's a lot of money if they stop focusing on these issues, trying to force these students into a worldview of race and gender, economic class, and that kind of junk. Okay, let's put it this way: it's garbage. Let's be real, and use it to something more productive. It's a shame. It's sad. They're spending $32 million, one state university, on racial initiatives and equity and diversity, and frankly, we've talked about it many times. It's just racist to view a person on the lens of skin color of any type that's the definition of racism. And for them to spend that kind of money promoting that kind of junk and that garbage, we fought a civil war over that to get rid of it. I thought we had a civil rights movement that got rid of a lot of that stuff. And now for it to come back and rear its ugly head again, that's just, it's sick. I'm sorry. It's evil, it's sick, and it's sad. That's without getting into a lot more. I think I just said all I need to say about that. But I love the way to attack it. Just cut the funding. That's the way you get at these people and these initiatives and these racists who want to promote racism. I just, I think it's awesome. And I hope we see more. I hope this is the beginning of, we're seeing more and more of this kind of stuff. In fact, another example is the BlackRock CEO. you know, where they have all these DEI initiatives, and they've been pushing really hard for companies to, how should I say, promote these kind of these DEI programs instead of sticking to the fiduciary responsibility of maximizing shareholders' returns, which is what they're supposed to be doing. But you know, Florida pulled $2 billion in assets that was from BlackRock, and he admitted. He said the CEO of BlackRock admitted it hurt us. And so again, that's where you get things done. You pull the money from them. Whenever you have a opportunity to do that, you just pull the money, okay? And I think that's the best way to go. Another bit of news I thought was interesting, and this was from Newt Gingrich. This is something and I've always kind of, whether you like him or didn't like him, I don't think that makes a whole lot of difference, frankly. I've always found him to be fairly astute from a political standpoint. He was a political operator, okay? He was a former what is it? House what is it? He was the House, you know what I'm saying, House leader. So anyway, bottom line is, he said he's saying some things about what I thought was interesting. Some things he was saying is, you know, Republicans and independents are watching inflation, the border, rising crime, social policies, deficits, you know, decline of American prestige, and you know, they just wonder how an administration with all these failures could be renominated. And you know, I have to admit, I've often thought that myself. It's like this is a train wreck of an administration. It's a complete and total disaster area. I can't think of anything that they have done that's positive. Hopelessly incompetent, it seems like, you know, or just intentionally just evil, frankly, in my opinion. But whatever. So the reality is, they like his policies of what he's doing because their goal, their purpose, is to get as much money, power, control from the government. They want to suck from the government as much as they can. That's why we have such fiscal irresponsibility. In fact, it's not about fiscal responsibility at all. It's about how much can they, money, power, whatever benefits they can get to their groups to then reelect them. In a way, and I've said this before, it's like bribery. It's like the Democratic Party has these different groups, like the teachers' unions or whatever, and if they can get enough money to them, then they make sure they'll vote for them, okay? And that's really what it's not good. It's not uplifting. It's not encouraging. It's about show me the money. Follow the money. That's why I always say, if you really want to understand something, I'm not saying I agree with any of this, but what I am saying is it kind of rings the bell. It rings true because you see what's happened, you see what's going on, and you see how they operate, and you realize, yeah, it really is nothing more than, hey, it's following the money. If the Democrats shovel more money to them, they're happy, and they'll vote them back in, and because what do the politicians want? To be elected, reelected, all that good stuff. They want power, right? So it's a power sharing agreement. You know, the politicians shovel money to the groups vote in the politicians so they get power. And it's nothing more than that. It's sad. It appeals to the baser human emotions of greed, things like that. It's not, like I said, it doesn't aspire to the higher ideals in any way, shape, or form. And I think that's one of the reasons why so many, if you will, folks on the conservative side of things, independents, whatever, who do aspire for something better, better for themselves, for their families, for their careers, their businesses, for their country. You know, it's an uplifting message. It's being patriotic. You feel, I was in the military. I get it. You have that patriotism, all those things, and you want to aspire for something greater, and you want to try to achieve something more. That's not how these people think. That's how they operate. They just want, give me more, give me more, give me more. And if you give me more, I'll vote for you so you can give me more. As long as you give me more, I'll vote for you again. It appeals to the baser instincts. Sad, but true. The last thing I want to share on this, and this is where I get some hope again from some of these things. Every movement, things like this, where things go too far one way, they have a tendency to overreach, and then you have a usually equal, if not stronger, counter uh, movement, if you will. And I love that. And I don't know what it's going to take for these people to realize enough's enough. But maybe this might be the one. It's you'll remember the Alamo moment. And it says New York City is threatening pizzerias and with coal and wood-fired ovens to cut carbon emissions, which would destroy their New York pizza, period. Look, New Yorkers love their pizza, even the liberal ones. And if these libbies get them to, in essence, destroy, I mean, they're going after stupid stuff now. I mean, there's like 100 pizzerias. How much carbon emissions can they really give off? It's a tiny, minuscule amount. Give me a break in the whole big scheme of things. But the bottom line is, if it destroys New York pizza, there's going to be a lot of pissed off New Yorkers, okay? And maybe that'll be the moment where they say, you know what? This government has overreached. It's too much, too far. I'm done. I've had it. Vote the bums out. Let's replace them. Get somebody else in there that will actually will represent us instead of just shoveling money to these special interest groups. And maybe this country can start going in the right direction. That's what I hope. I don't know if it's going to be the pizza or something else. One of these days, something's going to break, and the dam's going to break. And I think we're closer to it than we are farther away. That's my encouragement about it. That's my encouraging message. I'm going to encourage you to stay tuned to Your Personal Bank Show next week. And as long as it's still on our money, I will say this: in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank Show for more information. Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ference at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.